New Zealand's property sentiment appears to be divided still. National median house prices have been flat for almost half a year, the amount of property for sale remains relatively high, and the economy is still searching for genuine momentum. So, on one side, I'm mindful of almost $300 billion sitting in term deposits and on call accounts throughout New Zealand, earning even lower rates of interest income. But on the other side, I'm thinking of all the property owners desperate for better days so they can dump their bags. Banks might be forecasting 4 to 10% growth from here on in, but to see that, quite a lot more buying pressure needs to show up. If in doubt, zoom out. And I did. And I called Kelvin Davidson, Chief Property Economist at Cotality, and he joins me on this one to discuss his expert predictions on the official cash rate, the real impact of recent rule changes, and we'll also find out who's buying what right now and what should they expect from here. I hope you find value in the chat, and if you do, be sure to like and leave a comment on what you think will happen with property in 2026 in New Zealand. Let's get started. What would be your view around how low the official cash rate goes from here?
Yeah, I mean, I'm on board with the view that we've got at least one more cut to come. I think it would perhaps be a little bit odd to cut by 0.5% and then just stop. Now, that may happen. I mean, it depends a little bit, I guess, on what happens to the data, inflation, labour market, these sorts of things in the meantime. But to me, it would feel a little bit odd to finish with a 0.5% cut, because that's a pretty chunky sort of fall in the OCR, as well as the Reserve Bank's pretty much said in their statements that the exact words are something like they're open to more cuts. They haven't necessarily stopped yet. So I think the language supports another cut. Just the way these processes have happened in the past, I think, sort of lends itself to another cut. So yeah, I think we're probably looking at 0.25 in late November. That's of course the last meeting for the year. So then everything will come back in February next year. So there is that 3-month gap. Long time to obviously judge what happens in between November and February, and there'll be data coming in over that period, and who knows what that might say. But just at the moment, it feels to me like 0.25 would be the last one, so we'll get down to 2.25%. But if I had to put a bias around that, I'd say probably slightly to the downside, so maybe another cut to come after that. But we can't ignore the fact that the Reserve Bank's sole target is inflation, and at the moment it's a little bit uncomfortably high. And so if we did get some readings coming through that continued to push that up towards 3% or slightly above, would be a wee bit awkward for the Reserve Bank and cutting further. So I think inflation holds a big key. But for me, we get at least one more rate cut. I think it probably stops at one, but if I had to put a bias around it, it's probably a little bit further than that. But I think you also have to acknowledge that there are maybe the slightly green shoots. You wouldn't call them anything clear, but just some hints that the economy is starting to turn around. So the lagged effects of monetary policy are starting to work to some extent.
Got it. Yeah, green shoots definitely. I can definitely see the green shoots appearing in the economy. Very, very early stages though, right? And I guess depending on where you sit on the spectrum, it's not so much green shoots in the property sector. It could be more like the resurgence of a bad rash, right? Because a lot of people kind of don't want property to come back in full strength. They kind of want things to be more stable going forward. So I know that house prices are kind of like pretty much a side effect, or they're an afterthought, or they're a spillover effect of monetary policy. And the primary objective is to monitor inflation. But do you feel like the Reserve Bank of New Zealand is kind of indirectly trying to manipulate house prices through this mechanism, or is it genuinely an afterthought?
I mean, house prices aren't a target of the Reserve Bank. Their sole target is wider consumer price inflation, and they're the regulator for the housing market, in the sense that financial policy will play a role there. Things like the LVRs, which have just been loosened today, or they're going to be loosened in future. The announcement just came today. So LVRs and DTIs are a big part of what the Reserve Bank does, but that's more about financial stability rather than house prices per se. So for me, house prices are an indirect spill off of, or spillover, or indirect effect from what's going on as a part of the Reserve Bank's core business, which is trying to change the official cash rate to keep inflation within that 1 to 3% target. House prices will do what they do as a result of that. But yeah, I think at the moment we are looking at an environment where, I mean, house prices have been pretty weak for a long time. We had that downturn over 2022 and 23. Things have gone pretty flat since then. So we had those big falls. We haven't recovered to any extent since then. So the past couple of years have been pretty flat for house prices. But I think we're slowly emerging into an environment where you could see house prices start to rise again, and that is the Reserve Bank's forecast for 2026, is that house prices will go up. And for me, that's partly affordability has restored to some kind of normality. Listings are starting to come down a little bit. We've got that lagged impact of lower mortgage rates coming through, and the economy is expected to slowly turn around next year too. So some of those things that have been restraining house prices, I think will be a less of a restraint in 2026. So I think we're probably looking at some house price growth. And of course, there's always two sides to the coin. Some people will be very happy about that, property owners, property sellers. But of course, for buyers, they'd probably be a lot happier if prices were flat or falling further. So I always acknowledge those two sides.
Yeah, for sure. Now, a couple of three-letter acronyms just to flesh out a little bit and perhaps provide a bit more context, because depending on who people are, they may or may not know what a DTI and LVR is. But with the debt to income ratios, the DTI, do you want to just take me through what that is, how that works in general, and then with the LVRs, the loan to valuation ratio restrictions, talk us through what the latest is there.
Yeah, so DTIs, debt to income ratio restrictions, quite a simple measure, really. It's saying you can have X amount of debt in relation to your income. So for owner occupiers, that cap is 6, and for investors, that cap is 7. So let's say you earn 100,000 for round terms. As an owner occupier, you can have 600,000 of debt. So, and for investors, that's 700,000. So the idea is that it caps your debt sizes, caps your mortgage payments, basically, and it's there to I guess insulate households to some extent against an unexpected rise in interest rates, so that people don't take on too much debt, and therefore can more comfortably ride out a period of higher interest rates. Now, there is an exemption there, so banks can lend 20% of their finance outside those DTIs. So, if people are looking at their finances, they think, oh, I earn 100 grand, but I'd love to get a $1 million mortgage. You still have to meet bank servicing tests, of course, and prove to them that you can afford that loan. There is still room to do that. You don't have to be capped at 6 or 7. That's the standard number, but there is an allowance there to go outside. So that's DTIs. The idea is to sort of take the heat out of the housing market in these previous booms we've seen, is just curb those booms a little bit, curb debt levels, and keep house prices a little bit more under control. LVRs, loan to value ratios, so that's simply take the value of the property. You can have debt up to a certain level in relation to the value of that property, and so those rules have been around for a long time now. As things stand right now, 20% of lending to owner occupiers can go out at low deposit, in this case less than 20%, and 5% of lending to investors can go out at low deposit. For investors, that deposit is 30%. So hopefully those numbers make sense. But just today, the Reserve Bank has announced a change to that. And so they're going to say from the 1st of December, providing it goes through consultation, everything like that, 25% of lending to owner occupiers will be able to go out at less than 20% deposit or greater than 80% LVR. And 10% of lending to investors will be able to go out at less than 30% deposit or greater than 70% LVR. Now, that's a lot of percentages in there. Hopefully that all makes sense, and hopefully I've said it correct.
If you're a property investor, you have to have a 30% deposit generally, or 30% equity. But what you're saying is that's the bit that's changed, is that the amount that the banks are allowed to, at their discretion, lend beyond those rules, that's what's just been relaxed. Why didn't they just change the LVR limit itself rather than the amount of lending that would be exempted from those limits?
Yeah, it's an interesting one. So you're right. I mean, the deposits themselves haven't changed. It's simply the amount that banks can lend out at those deposit numbers. So the speed limit has changed effectively. That's the way the Reserve Bank's talking about it. And so, I mean, the DTIs are there. The idea is to protect borrowers. The Reserve Bank sees the LVRs as a way to protect banks. So home buyers, mortgage borrowers have to have skin in the game effectively. So those are the kind of big picture rationale for these things. Yeah, I mean, why didn't they just change deposit requirements? That's an interesting one. I mean, I find the whole change a little bit curious anyway, because at the moment, the banks are way below those speed limits anyway. There's only sort of 10 to 12% of lending going out to owner occupiers at a low deposit anyway, or a high LVR. So they're not even testing the current 20% speed limit, let alone the new 25% speed limit. So that's an
Mm,
interesting one. I think that the change in the speed limit for investors could be more meaningful, because at the moment, as an investor, if you don't have 30% deposit, it's very, very difficult, because that speed limit's almost nothing. So it
mm,
could be that this does tend to play into investors' hands a little bit more.
mm.
Now, keep in mind, new builds are exempt from both of these sets of rules,
Yeah,
so people can still look at new builds without necessarily those same deposit levels. You still have to satisfy testing requirements at the banks. But yeah, I don't really have a straightforward answer for why they didn't just change the deposit
yeah,
requirements. I think really,
yeah,
I guess it's just this idea that they want borrowers to have skin in the game. They
yeah.
want an owner occupied to have to put in a decent amount of cash or a decent amount of equity
Sure.
to secure that loan. So they say that's 20%. For investors, we'll say it's 30%. So that'll be part of the reasoning.
Let's move on to national median house prices. They have ticked up a little bit in September after some pretty negative months and 5 consecutive months, I think it was. And some of this probably would have been the market anticipating lower interest rates to come. Some of it would have been the usual spring rush that we would come to expect for this time of year. So, how much do you think the market is actually sensitive to interest rates, and how much of the market will just kind of go out and just do what it's going to do regardless of what's happening with interest rates? Because on my end, it kind of feels like people are probably almost too obsessed with interest rates, but maybe that's just me.
I'd probably still sum it up as the market being pretty flat. We had the falls over 2022 and 23. That's left values in some markets still down sort of 20 or 25% from that previous peak. I'm thinking here of, say, Auckland and Wellington. We're now in a market that probably for the last 2 or 2.5 years has been pretty flat. And I think really the last 6 months have just been a continuation of that trend. So I'd probably call it flat rather than necessarily sort of down and then up a bit. It's the trend is still pretty stable. We've seen mortgage rates come down a lot, and ordinarily you might have thought that would be pushing up house prices more than what it has. But I think we've just got this handbrake in the sense of a weak economy and weak labour market. I think that's the thing that's really keeping a lid on house prices at the moment. Confidence levels are low. We heard in the last monetary policy review that the Reserve Bank talked about excess precaution. There's just a lack of confidence out there, and so from their perspective, they're looking to get that OCR down and really just give that confidence a boost. Give the vibe a boost, sort of turn the mood around a little bit. So I think,
Yeah.
yes, mortgage rates have come down. I guess that upwards impact on house prices is still just kind of sitting there, just waiting for the handbrake to come off. And I think with unemployment and the economy set to turn around next year, that confidence effect should come through as well. It's a little bit chicken and egg, which happens first and all that. But
Mm.
I think both of those things will happen next year, and we should start to see house prices go up again. Might not be a boom because we've got things like DTIs, land supply is opening up. There has been still a decent amount of construction coming through. So
Mm.
for me, yep, house price growth next year, perhaps not off the charts, but more than what we've had in 2025.
Yeah.
And so I think it's just getting that handbrake of the weak economy off,
Yeah.
and then that impact of lower mortgage rates can be seen more easily.
That period of time where the previous government removed the ability to claim interest as a tax deductible expense when you're in the business of providing an accommodation service, like when you're a property investor, that was mistakenly referred to by people who don't know much as a tax loophole. And it's great to see that return, because that's kind of just common sense in my view. I'm slightly biased, of course, but how much of a factor is that in terms of the property market finding the floor this year?
You could probably say the floor for property values was reached in the middle of 23. We had those falls through 22 and 23, and since then, it's gone up a bit, gone down a bit. But if you look at property values on a long run chart, we've kind of been at a floor for a couple of years now. We've just been sort of bouncing along the bottom. So I'm not necessarily sure that the reinstatement of full interest deductibility has really turned things around this year, because it's been happening prior to that as well. But yeah, it's certainly a factor, and we have seen mortgage investors coming back to the market. The sort of cliched mums and dads are certainly back in. They've they've been buying property again, looking at new builds, looking at existing properties, right across the country too. So I think the mortgaged investors are back. It's been a tough couple of years, but they are back. Lower tax bills would certainly be part of that. Interest deductibility, that full reinstatement, whether you buy a new property or an old one, is going to help. Of course, anybody would like a smaller tax bill, but when you run the average numbers, when I run the numbers, it looks pretty obvious to me that the big shift has really been just simply mortgage rates. If you go back to the middle of last year when interest rates were 7%, let's say, the top up that most people would require on a standard rental property purchase could have been $400 or $500 a week out of other income that you've got to find. Now with interest rates down, that top up could be 200, let's say. Now, that, like I say, that'll differ for everybody, but on broad average terms, that's the kind of scale of change. And so that for me is the big shift. But yeah, other things have changed as well. Bright line test was shortened, LVRs were loosened last year and about to be loosened again. So all of those things help. But for me, it's for a debt-backed investor, somebody having lower mortgage rates is a huge factor.
Oh, totally. Now, I read one of the reports from Cotality recently, and I heard the term MPO, and I'm just wondering, like, is this more of a tactful or a socially acceptable way to refer to property investors now, multiple property owners?
No, that is a conscious choice of phrase because the way that we structure it in our buyer classification is they simply are multiple property owners. We're not trying to be sort of PC or anything about this, but also it does reflect the fact that I guess when people think of an investor as somebody who buys a property, rents it out. Now, within the multiple property owner bracket, you could have people with holiday homes. So there's all sorts of ways people can become a multiple property owner without necessarily being what an investor, as most people would think of it. So the multiple property owner phrase is simply a catch-all. We're not sort of trying to be sort of too clever about that. It's simply to represent or simply to acknowledge that there are different types of multiple property owners. You can be an investor, you might have a holiday home, that sort of thing. But generally, within that wider MPO category, most people will be buying property to rent out. That will be the dominant category in there. So we do use it a little bit interchangeably. We can get a bit casual sometimes. MPO for most people would be equal to investor, and I think that's probably fair enough, but we do like to keep that technicality there if we can. So mortgaged multiple property owners or mortgaged investors, that's the group I was talking about earlier. That's your people who might have built up some equity in their own property over time and suddenly go, okay, interest rates are down, maybe I'm interested in buying a rental property. So they buy their second property, they live in one, they rent one out, they're a multiple property owner, and it is those the wider comeback for mortgaged MPOs has been driven by those smaller players. It is your mums and dads who are perhaps buying their first rental property and just looking to save for their retirement, that type of thing.
Yeah, and so if there was a mortgaged multiple property owner versus multi-property owner, i.e., not mortgaged, the factors that influence them are obviously going to be different, right? Like I'm thinking about the debt to income ratio specifically. Like that's going to definitely be a handbrake for a portion of the market. Like when the market gets really heated, property investors pile in and owner occupiers, they're going to hit that limit. Like right now, it probably isn't going to be a handbrake because of the other things that will limit them. But if interest rates keep falling and things go up even beyond that, then those DTIs become a handbrake. But if someone doesn't need a mortgage to buy a property, whether it's their own home or an investment portfolio, then it doesn't matter. And I'm aware that there's a lot of cash. Unfortunately, not in my bank accounts, but there's a lot of cash that is sitting out there in the economy in term deposits, savings account, waiting to be deployed. And as some people look at the interest rates falling right now and they look at, oh, wow, okay, safe as houses, we're just going to pile back into property. Do you think that a lot of these things like LVR restrictions and DTIs and the tax rules, all that sort of stuff, just goes out the window a little bit more this time with the next property cycle because these are cashed up buyers that might buy more in the future?
Yeah, potentially. I mean, cash MPOs are always there. They're always, at least going through our data, the last sort of 20 odd years, the cash MPO line is always smaller than the mortgaged one. So it does tend to be your standard property investor on average will be somebody using a mortgage. They will be debt backed. But there are cash MPOs. Now, there is a little technicality in the sense here that the way we record the data, somebody might look like a cash MPO, but all they've done, they've got some other rental properties, and they've upped the leverage on those properties and used the so-called cash to make their latest purchase. So it
Yeah.
might look like cash on the latest transaction, but actually across their portfolio, it is more debt. So there is that slight technicality there. But yeah, generally cash MPOs are a big part of the landscape, and they won't be affected by, like you say, DTIs or interest deductibility even, or LVRs, because they're not borrowing. So yeah, there are different considerations for them, but I guess they're still wanting to get a good rental return. They don't want to overpay. Nobody wants to overpay. So some of those other motivations are definitely still there, and I guess they're affected by interest rates in an indirect sense. Perhaps if they've got some cash in the bank, that sort of thing. If interest rates on those investments or those savings are going down, then yeah, there is an incentive to push out into rental properties. So, for different reasons, lower interest rates kind of end up with the same result, which is for debt-backed investors. Of course, you start looking at property because it's cheaper to borrow, but for cash investors, you maybe look at property because your returns on having cash have gone down. So you look at alternative assets. So yeah, I think for me a theme over the next couple of years in the residential property market is certainly investors. We've still got a lot of first home buyers, and we've had good strength for first home buyers for 2 or 3 years now. But I think over the next couple of years, I think first home buyers will still be there, but it could be that investors are a bigger theme and a kind of group to watch in the sense of LVRs, DTIs, what cash investors are doing, what debt-backed investors are doing. So they're certainly back now, and I think it'll be a theme for a couple of years too.
And what kind of percentages are we looking at right now in terms of the first home buyer cohort next to the multiple property owner cohort, like property investors, owners versus investors? Are they roughly equal, or is one greater than the other right now?
You could categorize the market into four very broad groups who are about even. Now, it's not quite true, but lately we've had first home buyers running at about 27% of the market. So
Yeah.
about a quarter, let's say, give or take. You've got mortgage multiple property owners who are another roughly 25%. We're at their lowest point when the tax rules were against them and interest rates were high. They were down more at about 20% of activity, so they have climbed back to about 25. So those two groups are about a quarter each. Then you've got movers, as we call them, or relocating owner occupiers. They're at about 25% at the moment too. Now, typically they're a little bit higher, perhaps up at 30%. Movers have been relatively quiet lately. Just caution, I think, dominates. If you're a bit uncertain about the labour market, you maybe just stay where you are rather than looking to shift house. So they're about a quarter. And then the final quarter is everyone else. You've got cash investors in there. You've got maybe some foreign buyers, who aren't many, of course, but there are a few in there. You've got people who might have previously owned a property and sold out for a while, maybe unfortunately might have had a divorce or that sort of thing. So they've been out of the property market for a while. They've come back in. So we group everybody else into that final quarter. But broadly speaking, very broadly, you've got about a quarter of first home buyers, quarter mortgaged investors, and about a quarter as owner occupiers moving around. So yeah, those are the sort of scales, but that's a very broad categorization. At the moment, first home buyers are a little bit above where they normally would be, movers are a little bit below where they normally would be, and mortgaged investors are about on a par with historical numbers. So
Right.
that's a very broad summary.
We had, going back a little bit here, probably just over a month and a bit ago, we had a change to the active investor plus visas, I think they're called, where effectively, if you had a $5 million home or more, if you own that property, then there might be more competition from people that might be exploiting some of the rules to get into New Zealand, because that's kind of on purpose. So do you measure 5 million plus value homes? And if so, are you kind of seeing or anticipating any changes there?
We provide AVMs, automated valuations, or computer-based valuations of every property in the country every week. And banks use those heavily for lending decisions. Lots of other kind of organisations use them too. But from that, we can, for research purposes, we can have a stab at estimating how many properties are actually in that $5 million bracket across the country. And so we ran those numbers at the time, and we estimate there's about 6,000 or 7,000 properties across the country in total that are valued at $5 million plus at the moment. So
Okay.
out of about 1.6, 1.7 million total dwellings. So it's not many. I can't
Mm,
quite remember the percentage there, but it's pretty small, about zero point 0.4 or zero point
yeah.
0.5 of dwelling stock. So pretty small and concentrated in Auckland and Queenstown, as you'd expect. So it's only in a few locations as well. Now, the other thing is around that relaxation of the golden visa. It's all very well to say, the 6 or 7 thousand properties in that bracket. I mean, it seems like a reasonable number in absolute terms. It's small in relation to the stock of properties, but also keep in mind that they actually have to be for sale. And foreign buyers won't be able to snap those up if no one's actually willing to sell. A turnover rate in a standard property market might be sort of 5% each year. So, if you assume 1 in every 20 properties sell in any given year, there's about 7,000 in total. There might only be 300, 350 of these high value properties actually available to buy in any given year. So I think, yeah, pretty small. Obviously, people
Mm,
who are in the bracket, maybe people who had a house they were thinking about selling for 4.5 million, 4.7 million, they might be looking to
mm.
sneak that asking price up a bit. But
Yeah.
generally, I think the overall impacts of this will be fairly limited. It's
Yeah.
to the extent that there are impacts, it'll be in a few select suburbs. I'm talking, your Herne Bays, that sort of thing. But I think
Yeah.
there is a bigger impact in the sense of saying to people, look, bring your money to New Zealand to invest. We're open for business. I don't think there'll be a housing market impact, but potentially a wider sort of economic
Mm,
effect of more capital coming in, more skills. I think that's really the aim of this. Because keep in mind, at the time when the relaxation of the foreign buyer ban was talked about, tax was also on the table. It was about raising some income. That's off the table now. There won't be a
mm.
stamp duty. So it has moved on. But overall,
Yeah.
housing impact, I think, pretty small.
Yeah. I just wonder if there'll be weird little distortions and opportunities like buying two properties together, merging the titles so that you have $2.5 million become a 5 million, or the 4 million, they just put an artificially high price in there and throw in the furniture for $1 million extra. I don't know. I guess time will
Yeah.
tell, right? But usually with any of these rules, there's distortions. And I think with these distortions, that's where there's some unique opportunities. So,
Yeah,
but
oh, for sure.
yeah,
Unintended consequences are
yeah,
always there, and you can't sort of think of all the ways that people might try and get around these. But yeah, there might be special cases like that. But I think in general, like Joe Public doesn't need to be worried. I don't think.
no, no, that's right. Now, something that comes up every now and then with the people that I talk to, because I talk to people all over the country in different parts and different styles of homes. They live in different towns, big towns, small towns, everything in between. And this is interesting because it came out in the data that I saw. I think it was from Cotality as well, that the home values in provincial towns are more resilient, and if anything, they're rising, while the bigger city centers like Auckland and Wellington have been falling, or have fallen a little bit more. So I guess what I want to know is what's causing the shift away from the long-term trend that we had been seeing of centralization to the main cities, not decentralization. And do you think that this reversal will be sustained, especially when you think about expected immigration patterns going forward?
Yeah, I mean, we are seeing at the moment a wee bit of I suppose, a two-speed economy and a two-speed property market in the sense that farming's going pretty well as opposed to, say, the services sector. So kind of matches up that your big cities, Auckland and Wellington, might be lagging a little bit behind in terms of property values, whereas markets like New Plymouth and Chicago they're not booming, but they've shown a bit more resilience. So yeah, I think you can tell a story around that. There's a wee bit of a sort of urban regional divide sort of thing going on. But I mean, and maybe COVID, the remote working thing plays into all that. There are reasons for it. I find it hard to believe that it'll be that long lasting because, of course, ultimately, I guess your ability to buy a property is determined by things like your employment situation. And I think over the long run, still a lot of the employment growth will be generated in your big cities as the services sector comes back, your interest rates go down. You tend to see, I mean, you touched on immigration, you tend to see in periods of when the country as a whole has strong net migration inwards to the country, a lot of that tends to go into the main centres.
Mm,
In times of migration outflows or weaker net migration inflows, you tend to see that the population gets lost from the regions. So over time, there is this drift from the regions to the main towns, and I think that'll reassert itself over time. So yeah, there may be for a 12 or 18 month or 2 year period, whatever, it might appear to be a sort of provincial urban divide. But I suspect as the economy rebalances, as just the general cycle rebalances, we'll start to see Auckland and Wellington picking up again. So yeah,
Mm.
I wouldn't necessarily think this will be long lasting, but it does seem consistent right now with a two-speed economy.
Another thing that I've been seeing, probably more so in the last 12 to 24 months, is an increasing group of people within that cohort of first home buyers. And I guess what I probably should say is the people that I would typically normally see as your average first home buyer type profile, I'm seeing them not that engaged with the idea of buying a home, a first home. And it's not because they're going overseas to do a bit of travel. It's because they've kind of had a fundamental shift in worldview, not them individually, but them as a cohort of people, like as a generational shift. And it's like people don't think that property will ever reach all-time highs again. And I guess what I want to know is when I look at the bank's forecast, typically between 4 to 10% anticipated growth rates from here on in, it just doesn't seem to connect with what I'm hearing from people. So, what are you expecting more longer term? Not just next year, but what are you expecting, say, over the next 5 to 10 years? Are we still going to see the typical, 7 to 10 year doubling going on with property prices?
Yeah, look, we could probably fill a whole podcast just on this topic, but I mean, I'll try and keep it relatively short. I mean, I guess like I do think over the long term we might see less capital growth than what we've had in the past. Things like okay, it's got to stick through the political cycle, but this government's pushing very hard on land supply and trying to really ramp up that stock of housing. If that sticks through the cycle, it feels like that's going to be a bit more restrictive on house prices in the future. We've got
Mm.
DTIs now. Interest rates can't trend lower like they have done historically. I mean, they might drift down over a long period of time, but the scale can't be as big as what we've seen historically because we're already down at a lower level, and so that's part of it. And then what else is in their tax system? So the tax system arguably has been relatively favourable for property in the past. Maybe it's not so favourable in future. So these are all sort of big picture, high level sort of thoughts. But historically, as you say, property prices in New Zealand have tended to double every 7 to 10 years. That's a compounding growth rate of around 6 or 7%. So that's kind of what we've seen historically. Wouldn't surprise me if, as a ballpark figure in future, it's more like 3 or 4% maybe. So still capital growth, but less than what we've seen historically, and just reflecting the change in those sort of structural drivers. But at the same time, we'll still have a growing population for a while. These are long run demographic factors that underpin all of this, but we'll still have population growth. Construction costs will probably still go up, so that'll underpin the market to some extent with the cost of new builds. The just income growth that sort of underpins a bit of growth in house prices too. So then we'll still see capital gains. Maybe it's less than in the past, but still some kind of capital gain. Now, what that does for I don't know, generations of people, whether they want to buy a home or not. I mean, I detect maybe there is a little bit of societal change going on, but I'm also careful of saying this time is different because it's all very easy to say, well, house prices will never go up again when they're flat, and then as soon as they start rising again, everybody changes
Yeah.
their tune. So, I'm
Yeah.
always cautious of saying this time is different because in most cases it actually isn't. So I think
Yeah.
you've got to be careful of that. But yeah, I think there is a reasonable case for thinking capital growth is a little bit less in future, and it might have implications for property investors. I think we'll still have property investors. We'll still need rental property. I mean, it's worth pointing out that at the moment the media sometimes likes to portray the market as being one or the other. You can have investors or first home buyers, and they're in this sort of battle with each other. I don't think that's that helpful. I don't think it's really true. We need both, and at the moment we do have both. We've got investors, we've got first home buyers, so I think you need
Mhm.
both out there in the market. But long run for investors, it might just change the way they think about their investments. If capital growth is a little bit lower, you're going to have to potentially, if you want the same target return, you're potentially going to have some income yield as well. And so, is that about
Mm.
the type of property you buy? Maybe it's looking at a townhouse that might deliver a slightly better yield potentially. So those
Mm.
sorts of considerations could be part of it. So yeah, I think we'll still see capital growth. It might change the way that people think about the market, the different buyer groups, but I sense that there's still. I mean, we're still seeing first home buyers are pretty strong. And yes, there's always the anecdote of oh well, I'm questioning whether it's worth buying a property, but then in the hard data, we're still seeing people buy. So I
Yeah.
guess it comes down to personal taste, and I guess I'm always conscious of saying this time is different because
Yeah.
most times it actually isn't.
No, really, Kelvin. This time it is different. I promise it is different. We'll see. We'll see.
Also,
Now that's cool. Okay, now obviously Cotality provides a lot of data for banks when they're assessing property values, and consumers who are buying property and figuring out the value of the property. They probably had some experience with Cotality, but why don't you just give us a bit more of a picture on what Cotality does and how people can interact with it, not just when they're buying property, but in other ways.
Cotality is the whole idea. We're a very diverse business now, so changed a lot from simply providing automated valuations to banks. That's still a big part of our business, but it's not the only part. So that is one. That's probably the way that a lot of consumers would interact with formerly Corelogic, now Cotality, is through going to get a mortgage from a bank. The bank will say, okay, well, how much is the property worth? We don't want to overexpose ourselves on that. You'll get an automated valuation. So that's potentially the way that the people see Cotality. It provides services to real estate agents through a fairly well-known app called Property Guru. So that provides valuations, but also lots of different information about the property, location, how many bedrooms, what the land's like, all these sorts of things. Services to insurance firms around risk, flooding risk, seismic risk, all these sorts of things. So that's a big part. And also, I guess the thing that people might not know about is and that does fly below the radar a little bit. We have a big GIS service, mapping service, addressing. So we provide all of the addresses to emergency services. If an ambulance needs to get to your house, you want it to get there pretty damn fast. So they need to know where they're going. We provide all of that mapping, that addressing, keeping it up to date, fire and emergency, police, all of that sort of thing. So it's a very wide-ranging business. Obviously, dealing with banks, mortgage brokers, real estate agents. That's kind of the really front-facing, well-known sort of thing. But then behind the scenes, there's also climate change modelling, flood modelling, and that addressing service as well. So pretty diverse, and different people will know the business through those different channels.
Okay. Well, thank you very much, Kelvin. I appreciate your time today, having a chat about where the property market's going next year. I think it's, yeah, it'll be interesting to see if this time it is different or this time it isn't different, just different flavor.
No, always a pleasure. Always happy to chat about the market, and yep, we'll only know in hindsight whether it does prove to be different or not. But certainly one to keep an eye on. I'll be watching closely.
Yeah, same. Awesome. All right. Thanks again.
All right, thank you.